This video walks through how to record a simple purchase transaction with Goodwill. So first, what is Goodwill? It's really the value of an organization's reputation, their relationships with their customers, how widely known, how well thought of it is with the general population. And a company can't just say, oh, we're doing really well and we have a great name in the community, let's add $500,000 to our books. Can't do that. The only time Goodwill can be recorded is when a company is purchased. And the company that purchases this other entity, when they're recording it on their books, Goodwill is the difference between the fair value of all the assets that are purchased and the liabilities, the fair value of the liabilities that are acquired in that purchase. The difference between those fair values and the cash price that is paid. So it's assumed that the purchasing company is willing to pay a higher cash price than the value of all the assets because they're paying for this good reputation or the business relationships that are coming along with the purchase. Okay, so when we're recording this type of a purchase, we want to record the fair values of all the assets we're receiving and the liabilities that we're taking on, right? Things we don't care about. We don't care about accumulated depreciation. Now these, if you look at the little example here, these are the books of Diva Corp. Diva Corp is the one being purchased. We're recording the entry on Ampra Corp's books. Ampra Corp is the one doing the buying here. And Ampra Corp pays $320,000 in cash and also issues $110,000 note payable. So our total purchase price in this case is $430,000, the two of those together. So this information here tells us that down here is Diva Corp's old balance sheet before they were bought out as of that date, and that the amounts in this balance sheet are really close to the fair values with the exception of inventory, land, buildings, and equipment, and here they give you the fair values for those items. So remember, in a purchase, we want every item to be at its fair value. So to start this journal entry, I'm just going to copy all the accounts here because we're receiving all this these items, but we're going to have to delete a couple of them right off. And that's because when we buy buildings and equipment, we assume that we're purchasing them like new. It's like new to us, so we don't bring over any of the accumulated depreciation. We're just going to record what the fair value right now is of those buildings, equipment, etc. Okay, so let's go ahead and start our journal entry here. So cash, of course the fair value of cash is cash, so $45,000 is what we're receiving. Inventory, or sorry, accounts receivable, they don't have a different fair value for accounts receivable, so we assume this is our fair value. It was on their books. Inventory, that was on the books, but they said, the fair value is a little different. We always go by the fair value, so we only record $105,000 for inventory. Land also had a different fair value than what was sitting on their books. A little more valuable than was shown, so $90,000 there. The buildings, we don't care what's on the books here because the fair value is $70,000, so that's what we're going to record. Stay in the right column here. And then equipment also had a different fair value than what was on the books, so we're going to use that fair value. And then the amount on the books, they said it was about the right fair value for the patents, so record that. Now in this purchase, we are also picking up their liabilities. Now note, we never pick up their equity. Okay, equity is what we're paying cash for. I mean, the shareholders who own the old company are cashing out by the purchase price, essentially. So we always ignore the old equity, but we do pick up their liabilities. So I'll just copy these two. We're going to have to credit for the accounts and notes payable, and those are at their fair values. Usually you owe what you owe. There's not too much difference there. Okay. Okay, so we've recorded all the fair values off their books. Now we need to record what did we pay for this company. Well, we paid cash of $320,000 there. So we have to credit our cash. We also issued $110,000 notes payable. So we borrowed to buy part of this. So I'm going to add on to the notes payable here. Their company had 50 to start out with, and I'm going to add the additional $110,000 that we took on to buy this company. Okay, so that right now is how our journal entry looks. Of course, you know journal entries have to balance. So the goodwill is our plug figure. It just represents, because these are all the fair values of assets and liabilities, and the purchase price, the difference between purchase price and the net of everything else is goodwill. So to do that, we need to make our entry balance. So down here, I'm just going to put in a sum so we can see how far our debits and credits are off right now. So our credits are $640,000 more than our debits. So that difference is $130,000. That means our goodwill, if we make it $130,000, now our entry is in balance. Okay, so goodwill, this number, it looks like, is picked out of the air, but since they were willing to pay that much more cash than what the net assets were on the books, that's the general value of the intangible goodwill.